We want to expand our markets conversation now and bring in Michelle Schneider, Partner and Director of Trading Research and Education at MarketGauge.com. Always good to see you, Michelle. So we've got this big Fed symposium kicking off in Jackson Hole. Earlier today, our Brian Chung spoke with the Kansas City Fed President, Esther George, who said now is the time to start tapering the bond asset program. What camp are you in?
Well, I think, first of all, that it's going to be what Powell says that's going to matter the most. So I know Bullard came out very hawkish this morning as well. And of course, we can make a case for the fact that the market should be able to handle some level of tapering. Of course, we know it started at $120 billion a month, going back to when the pandemic really hit last year. So a slow taper wouldn't be the worst thing. Certainly, it might go a long way to prevent some of this crazy inflation that we're still predicting will happen. But on the other hand, we know that they're looking at all of the concerns. The name of the whole symposium is Macroeconomics for an Uneven Economy, and there you go. We haven't had really strong statistics. The GDP came out today strong, but a lot of the retail sales numbers and some other numbers that have come out more recently have shown some of this slowdown after this peak. So I would expect that the Fed will be afraid to really come out and start doing anything at this point. And we'll want to see how the Delta variant goes, how the situation in Afghanistan plays out, and of course, how we look economically as we continue into a lot of big numbers coming up next week.
For sure. And actually today, of course, we got those jobless claims numbers rising for the first time in 5 weeks. So still sitting near that all-time pandemic low, which is, of course, encouraging. Seems like the job market has been able to hold on to its footing despite the rise in the Delta variant. But what do you think that tells us about the job market going forward? We know that the Fed, it's one of the components it looks at very closely when it thinks about policy.
Well, I would expect with the benefits finally going away very soon, whatever's left of them, a lot of them have already gone away, we could see somewhat of a boost to the job market. But whether or not it's sustainable, that's really what I question. I actually do not see great strength for the labor market. I had a big hope on the infrastructure package, but that seems to be so on the back burner right now. Would love to see some jobs created there. But as we know, people don't really want to go back to work. Job openings are also really strong right now, from everything from working in a basic restaurant to a salesperson and on up. So I'm kind of thinking that people may not necessarily be so ready to go back to work. And if they can't work remotely, we'll stay back home and see how it goes. So I think the Fed's right to be concerned about the labor market right now.
And another thing they're very concerned about, of course, is inflation. And we're seeing it sort of be sustained. I mean, there was talk about it being transitory. It continues to be pretty high right now. We're seeing it play out in the commodity space as well. What are you telling clients in terms of sort of bulletproofing their portfolio as best they can in an environment where we not only have inflation, but could be looking at having stagflation?
Absolutely. And yes, Alexis, you mentioned that the Fed is concerned, but I haven't heard them really change their tune about the transitory inflation. And I think this variant actually puts us even in a more precarious situation when that comes back, because now that demand, which has come back a little bit here, versus the supply, which really hasn't come back, that demand goes another spike up, and we're into a super cycle of inflation with this stagflation. So I would say the Fed should be concerned about it, but they are really in a tough spot, because if they say, well, we're going to have to deal with inflation by raising the rates, we know that's what's going to happen to the economy and the market. So I think they're going to do on a wait and see. And if they're lucky, it won't get out of control. And if they're not so lucky, it will. And then we could be looking at a 1981 type situation again.
Oh, goodness. All right. Well, we're going to have to come and talk about it if and when that happens. Michelle Schneider of MarketGauge.com. Good to see you. Thanks so much.